I do believe this will be the greatest real estate correction in my lifetime.
I do believe this will be the greatest real estate correction in my lifetime. It's going to be at epic levels, he continues. Now, this isn't news to most of us because the interest rates in the real estate market have been hiking up for a long time, but this is a whole new level. Let's take a look into the whys and hows of this hike that has got buyers and sellers alike shaken. Various factors can influence real estate markets, and one significant factor right now is high interest rates. These rates are dampening demand, leading to some reductions in home prices, although the impact varies across regions. According to the National Association of Realtors, the market for single-family homes is holding up well. Real estate investor Grant Cardone believes we're facing the greatest correction in the industry, calling it the greatest in his lifetime. Speaking on a podcast, Fox and Friends, Cardone talked about the upcoming opportunity for everyday individuals to acquire prime real estate from institutions. According to him, this is unprecedented in the country, and he expects the correction to reach epic levels. This scenario, he suggests, presents a golden chance for regular people. The median prices for existing home sales have been consistently increasing since 2020. In that year, the median price was $300,320. By 2021, it rose to $357,100, and in 2022, it further increased to $392,800. These figures indicate a steady upward trend in home prices over the past few years. While high interest rates may be affecting demand, the real estate market, particularly for single-family homes, has come to stay. The rising median prices suggest ongoing strength in the segment of the housing market. However, the impact of interest rates on demand and prices can vary. Grant Cardone argues that the housing market is in a challenging phase due to high interest rates and housing costs. Despite his assertion that the industry is in uncharted territory, he points out significant issues for both buyers and sellers. The current situation sees sellers avoiding the market, leading to low inventory and causing home prices to rise. Cardone believes home ownership is increasingly unaffordable, attributing the problem to the Federal Reserve's interest rate hikes. Cardone places the blame on Federal Reserve Chairman Jerome Powell, accusing him of inadequately managing inflation and negatively impacting the housing industry. In response, he calls for Powell to step aside and let the market correct itself to revitalize the housing sector. According to Cardone, the intervention of the Federal Reserve is hindering the natural correction needed for the housing market to thrive. Cardone also suggests a solution to address the challenges in the housing market. He believes that for housing prices to decrease, interest rates need to come down. Contrary to common belief, he argues that lowering interest rates will lead to an increase in mortgage applications and encourage people to sell their homes. This perspective highly questions the conventional understanding of the relationship between interest rates and home prices. In recent years, the real estate market has undergone some unusual and slightly irreversible changes, largely influenced by the COVID-19 pandemic, altering how people live and work. The pandemic triggered economic packages that infused cash into Americans' hands through initiatives like stimulus checks, PPP loans, and EIDL programs. As a result, this influx of funds flowed into the real estate market, causing prices to surge, particularly in residential areas. However, according to Cardone, as previously mentioned, the anticipated correction might not impact single-family homes as much. The pandemic's economic aid programs had a substantial impact on the real estate landscape. With financial support from stimulus checks and various loans, individuals entered the housing market, driving up prices. While this contributed to a period in real estate, Cardone suggests that single-family homes might experience a different trajectory in the upcoming correction. The rise of remote work options has unleashed a noticeable change in how and where people choose to live. With the freedom to work from home, individuals are no longer bound by proximity to physical offices. This newfound flexibility has prompted many to relocate based on personal preferences rather than employment constraints. This substantial wave of relocations has particularly impacted high-demand regions like Texas, Arizona, and Florida, driving up property prices in these areas. As the initial hesitations about travel during the pandemic eased, there was a surge in Airbnb bookings, which extended into the residential real estate market. This trend encouraged more people to invest in properties, capitalizing on the emerging opportunity to host for additional income. According to a 2021 report from Airbnb, new hosts in the furnished rental sector collectively earned $1 billion during the pandemic. Notably, Top earnings were reported in cities such as Los Angeles, the Smoky Mountains, and Atlanta. This influx of income from hosting further fueled the drastic rise of home prices in these locations, contributing to the evolving environment of the real estate market. Cardone highlights the impact of high costs on first-time buyers, preventing them from realizing their home ownership dreams. Renters, too, faced economic challenges, which reported a short decline in the U.S. rent-to-income ratio in the third quarter. Despite this decrease, the ratio still stands at 30%, the threshold being considered rent-burdened. According to Cardone, the Federal Reserve's actions will contribute to an increase in renters over the next 2 years. He believes the shift to be because of the current state of mortgage applications, which he claims are at all-time lows. The landscape of office spaces is also undergoing a notable transformation influenced by various factors. Despite initial expectations for a robust return to offices, the reality has been different. A recent bankruptcy filing of WeWork, a company specializing in co-working spaces, hints at potential challenges following the commercial real estate sector. A 2023 report from the global management consulting firm McKinsey goes into detail about the demand for office spaces in the post-pandemic era. The analysis highlights a decline in office attendance, particularly in major cities, leading to a decrease in asking rents in real terms. Notably, New York City experienced an 18% decline in rent prices from 2019 to 2022, while San Francisco witnessed an even more substantial 28% decrease during the same period. This change can be due to changing work situations, with many companies adopting hybrid or fully remote work models. The reduced need for traditional office spaces has a cascading effect on the commercial real estate market. These adjustments are not only affecting rent prices, but also raising questions about the future of office-centric businesses in the evolving work landscape. Glenn S. Phillips, the lead economic analyst of Lake Homes Realty and Beach Homes Realty, overseeing real estate brokerages in 34 states, also predicts a positive result for single-family residential real estate in 2024. According to Phillips, data and market analysis indicate that this sector will remain robust, with prices likely holding steady or experiencing slight increases. In agreement with this perspective, other real estate investors, including Steve Davis, the CEO of Total Wealth Academy, concur with Grant Cardone's assessment. They believe that the current scenario presents a significant opportunity for everyday individuals to seize high-value real estate from larger institutions. He said, "I happen to agree with Cardone on this one. We're already seeing dramatic price drops from sophisticated sellers who recognize that the higher interest rates make their property worth less to credible buyers." Despite this optimism for residential real estate, experts acknowledge challenges in other sectors of the real estate market. These challenges are expected to correct themselves over time, as historical patterns suggest. As the real estate landscape undergoes changes and corrections, investors and industry professionals remain vigilant and have to strategically position themselves to go with the flow. In the ever-changing real estate world, having cash on hand is often considered essential. The saying "cash is king" holds true, especially when aiming to acquire valuable properties at discounted prices. If your goal is to make the most of potential real estate opportunities, the first step is accumulating enough cash to be ready when the right moment arrives. When anticipating a market correction, particularly impacting commercial properties such as office buildings and multifamily apartment complexes, having sufficient cash reserves becomes crucial. You might initially believe that such high-value real estate is out of your financial reach, but there are ways to explore investment avenues even with a limited budget. One approach is considering smaller-scale investments like acquiring smaller multifamily properties or participating in the ownership of strip malls. Another strategy involves forming partnerships or limited liability companies or LLCs with others, pooling resources to collectively invest in real estate ventures. This idea allows individuals to combine their financial strengths and explore opportunities that might be challenging to pursue alone. Additionally, real estate syndicates provide another avenue for investment. These are a group of investors who join forces to collectively invest in larger real estate projects. By participating in real estate, you can contribute a smaller amount of capital compared to the overall investment, making it a more accessible way to get involved in substantial substantial real estate deals. The key takeaway is that while large-scale commercial properties may seem daunting, there are practical strategies and collaborative options for individuals even with more modest budgets. You can explore participating in the real estate market during reasonable times. Being prepared with available cash and exploring alternative investment structures can position you to take advantage of potential discounted property opportunities. And there ends our video, folks. Like, subscribe, and click on the bell icon to stay updated. Thanks a lot for watching, and we'll see you in the next one with more info on finance.